Morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for February the 11th, 2022. We have some green back on the screen. Metals are down. Silver is down 39 cents, down 1.67. We got a little bit of a correction, you might say, here on precious metals. Let me adjust the charts here. But we have activated some buy signals here on silver as it came down into that 22.99 level that you see here on the screen, just to get right into the market here. And we took our first buy signal here from this level and took out the first $325 profit here. The signal was activated from the buy level of 22.99 daily and the weekly average price of 22.99. As we come into this session, if you are neutral, then you want to wait for the price to activate a signal either by closing above or below these pivot points that we use. The algorithm identifies, once again, the color as support and resistance. Basically, when it's in blue, it's in an area of support, and as you can see, the daily signals, we're trading around or below the blue area. And this whole area is considered a buying area, an accumulation of supply, an accumulation of inventories. Even though the market may produce short signals, the algorithm tells you when short signals are produced below the buy 1 or the buy 2 level, don't take them, because the probabilities are very little for that trade to be successful. So when it came down here, it activated a short trigger, and the AI tells you that you don't want to take those short trades because you only got about a 10% probability from the buy 1 level, and the buy 2 level, it's only a 5% probability if you go short. Even though it may come down into this area, you want to be looking for a reversal above this pivot points. So here's the first reversal at about 11:45 last night, and didn't follow through. Came down, and here, if you bought it here, for example, and if you're buying particularly from the buy 1 or even buy 2 area, then I use a dollar stop, and I recommend basically to use a dollar stop. I use it myself. I don't use straight stops. I don't recommend using straight stops unless you are locking in a profit and using a trailing stop. So, but if you're a conservative trader and you want to have a short-term protection, then you can put for you to get out on a close below the previous pivot point, in this case 12.99. So if you got out here, then you want to wait again for another signal until the energy resolves. That's the reason why I say when you're down into these levels, use a dollar stop so that you can allow for the volatility here to trade. We're talking about the extreme level of speculation on the short side. And what we see here is basically an exchange of that supply and demand. Above the daily number of 22.99, you're looking at a buy trigger. So I allow for a dollar amount that will allow for the volatility. And that depends upon your profile. If you want to use a dollar stop, what I call catastrophe stop, not a straight stop. So if you go into a trade knowing your catastrophe stop from this level, you can measure it, then you know where you need to get out. Either put a dollar stop or, a price level on a limit order. Here, it accelerated finally into the momentum indicator. Now, we already made our money here on this signal for the day, so I don't mind taking the time and teach you how to make $300 in the first 5 minutes. So depending upon your multiple positions, how many contracts you took down here and so on, then you can begin to manage your position with a trailing stop. The target automatically is activated above 23.36. Is your final target for you to go flat. Now, the way that I use this indicator, this algorithm, is basically as a GPS. It tells me I want to trade, where is the strongest area, highest probability to start. The signal is confirmed. You have a 90% probability of a buy trigger as opposed to a 10% probability of a short trigger. And automatically it enters the trade and it gives you a target and 3 levels of stops. The third stop is a close below 22.77. If you have a large appetite for risk for that amount. If you're building a position, for example, which is what we're doing. And in order for me to manage, and we're talking about how do I apply the VCPMI in terms of money management. And so from here, understanding that we have, let's say, a signal here, then you can look at derivatives related to silver, for example. You can look at a stock, in silver, like SILJ, for example, which is an ETF. You can look at a stock. You can look at several different instruments. That are in the derivative category of silver, let's say, or gold. So there are a number of available ways that you can manage your position. Let's take a look at the gold market here, and we can get into a little bit about interest rates, the dilemma of interest rates, and the dilemma of inflation, which is another fundamental issue that we're dealing with. But let me come back here. In terms of the gold market, where we are, if I can interpret for you the AI behind this pivot points, which give you a color, and the green color is the average price. So once we extrapolate the average price, then we can calculate the extremes above or below that average price. And what we see here is that the average price has activated a bullish price momentum. When the price trades above the average price, it identifies the price momentum within the larger trend. And so when it activates a bullish price momentum, it automatically activates the targets above, and in this case, it's 1839. 1839 is the daily target that you see on the right of the chart. 1839 happens to be the weekly target as well. So now we have identified the weekly and the daily targets, which is called a harmonic alignment, and it just so happens that it is at 1839. Now, that is one of the strongest relationships that you can identify using the VCPMI, which means that upon completion of that target, there is a high probability that upon completion that we can begin to see some supply come into the market, more inventory, which basically means sellers. This prepares you for where mathematically the sellers are going to be situated, as the level below is a buy level or support level, or what the algorithm tells you, it's for you to accumulate supply, or the levels above that begin to tell you where you can potentially identify sellers. It's a distribution of supply. It's a distribution of inventory. It's where sellers potentially have the price level at a basically mathematical probability that the price is over extreme or overbought. So there is no signals on day trades, okay? But there is a bullish price momentum. And so how do you manage that bullish price momentum? Basically depends upon your profile and your ability to identify trading opportunities when it gets down to levels and the application exponentially into other instruments like stocks, ETFs, options, future spreads, option spreads, synthetics. There is a whole menu of strategies, and they're all too complicated to do it in a half hour, more or less. But it certainly is an idea in terms of identifying some of the strategies here as part of this live show for the benefit of my subscribers here in YouTube. And I want to take the time for basically thanking everybody that is sending emails that are positive and also criticism. I appreciate that. And any comments, please let me know. Like and share. Let's take a look at Bitcoin. The methodology of the VCPMI is a universal formula, basically, that is adjusted and recalibrated based upon the data for each instrument. And what you see here for Bitcoin is that the market came down to the buy one level at about 4:45 p.m. It was the first time, and we've seen a reversion from here, a buy trigger from here, and following the same methodology, the target is 44,337. The buy trigger is here, and below here you had three choices of stops, as I gave you. No straight stops, but you could begin to trail your position by using a trail stop if you choose to do so. And that trail stop generally would be the low of the previous day. And as the market moves into the target zone, then you can continue to increase that trailing stop. Or you can have a dollar amount. This is a GPS for your trading. It tells you where to enter, what your protection is. It gives you three methodologies, and it gives you a target to take. So it's, pretty much compartmentalized, you might say, into the structure for the day that we're looking to day trade. Now, I do use the daily signals, obviously, in combination with the weekly signals. And on the left here, you see the weekly number that stays for the rest of the week at 44,007. And that was accomplished at 6:45 a.m. today by making a high of 440. It completed the pattern, and it gave us this bearish trigger point that essentially you could trade if you want to take the risk. Again, following the same methodology, this is where you would go short if you want to day trade the market. Your stop would be 44,407, and your target is 42,768. If you are willing to take that risk. or if you're willing to take the trade. Depending upon your position, your self-directed profile. So what I am choosing to do is to look to trade the market from the long side. I will leave the money on the table. This is how I'm using the VCPMI, because if we do close above 44,007, it's activating the levels of 45,243 all the way up to 45,917, possibly. So if you're not long, obviously you want to wait either until the market comes down to 42,768 again, which it did a couple of times here, testing this level, all the way to this level here at about 9:45 p.m. But you can see that the buyers here were greater than the supply that came into the market, that is coming into the market. So in this case, with Bitcoin, I want to buy the highest probability trades, and I am holding long positions and recommending to hold long positions in Bitcoin. Now, if we talk about the fundamentals here for a minute, we are dealing with two elements that I believe are very important. One of them is inflation, and the other one is interest rates. And the 10-year note is trading around 2%. Which is pretty much flattening the yield curve, inverting the yield curve, where short-term rates are rising faster than the 30-year note. And this is basically, I think, one of the better indicators than some of the economists' polls out there that sometimes are completely the opposite of what the market wants to do or is doing. And so if we take a look at interest rates, if we look at the 10-year note, we were down to about 0.53 as of January the 7th. (2020). But let's say 0.50 here we're looking at, to about 2% that we saw yesterday. That's a 400% increase in the 10-year yield curve. Yield. While inflation is at 7.5%. And that spread of negative 5.5% yield is a telltale sign, potentially warning, not confirmation, but warning of a recession, putting pressure on short-term rates to move sharply higher than the 30-year bond. Now, there's a lot of rhetoric right now, a lot of opinions about Fed officials looking for 1 full basis points in 6 months. The 30-year bond is at 2.30. And inflation is at 7.5. And so, you're running roughly anywhere between a negative 5 to a negative 5.5% negative rate on the yield curve. So, I believe one of the reasons why the Feds are hesitant to raise interest rates aggressively is because of the risk of putting the economy into a recession. The yield curve is already warning of a potential recession if we see interest rates shoot up, particularly into that 2.5 or 3% level, which is reminiscent of 2018, the first time the Feds increased interest rates by a quarter point. The bottom of the market was made in precious metals, gold, and silver. And now that we're looking at Bitcoin as a digital gold, right along with gold and silver, I believe is the way to go into this economy in order to essentially protect yourself against this present time in terms of getting any kind of real return on government bonds. It's not only the price inflation that we see in, which is, it can be argued as a consequence of the supply chain, the pandemic. You can use any of those as a point of reference. But I believe the real reason why rates are going to be moving up is because the dollar is imploding. And you're getting monetary inflation as well as price inflation into a shortage of supply with record demand. It's an unusual combination, and I believe this is the cause for great volatility as we move forward. And as a trader, volatility is your friend. In the meantime, my friends, stay long on gold, silver, and Bitcoin. And I'll talk to you this afternoon on Market Wrap. Have a great trading day. Be safe.